Nike stock just crashed 15% in a single day after earnings. And what makes that move so interesting is that the headline numbers were not terrible. In fact, Nike actually beat earnings expectations. The company reported earnings per share of 35 cents, well above analyst estimates of 28 cents. Revenue came in at about $12.39 billion, which was roughly in line with Wall Street expectations. So if Nike beat on earnings and basically matched on revenue, why did the stock get destroyed? Because the market was not focused on the past quarter. It was focused on what comes next. And Nike's guidance was bad. The company said sales are expected to fall between 2 and 4% in the current quarter. That is a big problem, because analysts were actually expecting revenue growth of about 1.9%. So instead of growth, Nike guided investors to another decline. That gap between expectation and reality is exactly the kind of thing that can crush a stock. And that was only part of the problem. Nike also said Greater China revenue is expected to fall around 20% year over year in the current quarter. That is one of the biggest reasons investors panicked. China is a critical market for Nike, and management made it clear that weakness there is not temporary. They are still reducing sell-in, cleaning up the marketplace, and trying to align inventory with full price demand. In other words, Nike is still in repair mode, and that repair process is going to keep pressuring revenue. The next issue was margins. Nike's gross margin fell to 40.2%, down from 41.5% a year ago. Management said a major reason for the decline was tariffs in North America. The company specifically pointed to a 300 basis points impact from higher tariffs in North America. And in that segment alone, gross margin fell 360 basis points. That matters because even if Nike stabilizes sales, lower margins mean lower profits. And there is another layer here that investors did not like. Nike admitted that digital is still too promotional, and markdowns across the marketplace remain elevated. That means Nike is still discounting too aggressively to move product. So now, investors are looking at a company with slowing sales, pressure in China, tariff-related margin damage, and too much promotional activity. That is not the setup Wall Street wants to see in a turnaround story. And that brings us to the biggest point of all. Nike's turnaround is taking longer than expected. Management said they are still in the middle innings of the comeback. They are still removing unhealthy inventory from the market. They said those inventory cleanup actions created roughly a 5-point headwind to reported results this quarter. So yes, Nike is trying to fix the business. But the fix is costly, and it is slowing growth in the short term. The company also took a $230 million severance charge tied mostly to supply chain, technology, and Converse. That may help profitability later. But right now, it adds to the sense that Nike is still deep in restructuring mode. Now, to be fair, there were some positives. North America revenue rose 3%. Wholesale revenue increased 1%, led by 11% growth in North America wholesale. Running was especially strong, growing more than 20% in the quarter. And Nike said its new Nike Mind platform sold out globally, with demand strong enough to double production after more than 2 million consumers signed up. So this was not a total disaster. The brand still has strength. Innovation is still working in some areas, and North America is showing signs of improvement. But none of that was enough to offset weak forward guidance. That is the key lesson here. Stocks do not just move on what happened. They move on what management says is about to happen. And Nike basically told investors that revenue will stay under pressure, China will get worse before it gets better, and the turnaround still needs more time. That is why the stock fell 15%. So the real reason Nike crashed was not because the quarter itself was awful. It was because guidance disappointed, margins weakened, and investors realized the recovery story is still far from complete. And until Nike can show real improvement in China, healthier margins, and a faster turnaround, the stock may continue to struggle. Now the big question is Nike a buy after this drop? Right now, Nike is starting to look more attractive from a valuation perspective. The stock has pulled back significantly, expectations are lower, and a lot of bad news is already priced in. But I would still be cautious here, because this is not a clean turnaround yet. Nike is still dealing with weak growth, pressure in China, margin issues, and a restructuring that is taking longer than expected. Yes, the long-term story could work, but the short term is still uncertain. So if you really want to add Nike to your portfolio, it might make sense to start with a small position. But personally, I would rather wait. I would wait for clear signs that the turnaround is actually working. Things like improving margins, stronger growth in China, and less reliance on discounting. Because once those things start to show up consistently, that is when the risk goes down significantly. Until then, Nike remains more of a watch list stock than a high-conviction buy. And in this market, patience usually pays off more than trying to catch the exact bottom.